Venezuela sits atop the world's largest proven oil reserves, a blessing that once fueled prosperity, but also a curse that left the nation dangerously dependent on a single commodity. For much of the 20th century, oil was the engine that powered Venezuela's rise, transforming it from a rural backwater into one of Latin America's wealthiest nations. The black gold beneath its soil promised endless opportunity, but it also sowed the seeds of future turmoil. For decades, oil money built a thriving middle class and modern infrastructure, tying Venezuela's fate to global oil prices and U.S. refineries. High oil revenues funded schools, hospitals, and ambitious public works, raising living standards for millions. The country's fortunes soared when prices were high, and its leaders became accustomed to spending lavishly, confident that oil would always provide. But this reliance created a boom-and-bust economy, making long-term planning nearly impossible, and opening the door to corruption and mismanagement. When oil prices dropped, the economy would spiral, leaving the government scrambling to cover basic needs. The volatility bred uncertainty, and the easy money often disappeared into the pockets of the powerful. Leaders used oil wealth to secure power, neglecting to diversify the economy or invest in other sectors. Political elites prioritized short-term gains and loyalty over sustainable growth, deepening the country's dependence on oil and leaving other industries to wither. When oil prices crashed, the nation's fortunes collapsed, exposing the fragility of its prosperity. Suddenly, the social programs and subsidies that once seemed permanent vanished, and ordinary Venezuelans faced shortages, inflation, and hardship on a massive scale. Now the very resource that once attracted billions in U.S. investment is at the center of bitter disputes over expropriated assets and unpaid debts. International lawsuits and sanctions have only deepened the crisis as Venezuela struggles to regain control of its oil industry and its future. Venezuela's journey from energy powerhouse to debtor nation is a cautionary tale of resource nationalism and the risks of putting all your eggs in one basket. The story of Venezuela's oil is a reminder that even the greatest natural wealth can become a double-edged sword if not managed wisely. Venezuela's oil industry was built on American expertise and capital. U.S. companies like Standard Oil brought the technology and investment needed to unlock Venezuela's heavy crude, transforming the country into a global energy exporter. For decades, this partnership brought prosperity to both sides. American firms profited while Venezuela modernized. U.S. engineers and executives lived in Venezuelan oil towns, forging deep commercial and cultural ties. The collaboration created world-class infrastructure and helped PDVSA, the state oil company, become a major player. But as Venezuela's confidence grew, so did resentment over foreign control and profit sharing. Nationalist sentiment took hold, and the era of cooperation gave way to demands for greater state control. The stage was set for a dramatic confrontation that would upend the industry and reshape Venezuela's relationship with the U.S. Hugo Chávez's 1999 election marked a turning point. His Bolivarian revolution aimed to reclaim Venezuela's oil for the people. Foreign companies were forced to become minority partners with PDVSA or leave, losing operational control and profits. The government's message was clear. Venezuela's oil would serve social programs, not foreign shareholders. For international firms, this was a hostile takeover of assets built over decades. The result? A loss of investment and expertise, declining production, and the start of bitter legal battles. Venezuela's oil industry, once world-class, began a steep decline from which it has yet to recover. Faced with Chávez's ultimatum, ExxonMobil and ConocoPhillips refused to become minority partners and walked away. The Venezuelan government seized their assets, billions in infrastructure and projects, calling it nationalization, but the companies called it expropriation. This sent a chilling message to global investors. Contracts could be torn up at any time. PDVSA struggled to replace the lost expertise and capital, and Venezuela's oil output began to fall. The companies didn't just accept their losses, they launched international legal battles seeking billions in compensation. The conflict shifted from oil fields to courtrooms, with arbitration cases dragging on for years. The exodus of U.S. oil giants marked the end of an era and the start of Venezuela's isolation from global capital. The legal saga over expropriated assets would haunt Venezuela for years to come. ExxonMobil and ConocoPhillips took their fight to the World Bank's arbitration court, arguing Venezuela had illegally seized their assets. After years of litigation, tribunals awarded them over $11 billion in compensation, a landmark legal victory. But collecting the money proved nearly impossible. Venezuela, mired in crisis, refused to pay more than a fraction. The companies began targeting Venezuelan assets abroad, especially Citgo, to recover what they were owed. These unpaid awards became a major part of Venezuela's ballooning foreign debt. The relentless legal pressure further isolated Venezuela from global markets and complicated any hope of recovery. The billions owed to U.S. energy firms remain a major obstacle in U.S.-Venezuela relations. The legacy of Chavez-era nationalizations continues to cast a long shadow over the country's future. Venezuela's economic crisis is compounded by a staggering $150 billion in foreign debt, nearly double the size of its economy. Years of mismanagement, corruption, and oil industry collapse left the government unable to pay its bills, triggering massive defaults. Locked out of global markets, Venezuela can't import essentials like food and medicine, fueling hyperinflation and a humanitarian disaster. Millions have fled the country, and public services have crumbled. The government owes money to bondholders, China, Russia, and U.S. corporations with arbitration awards. Competing claims have created a chaotic scramble for Venezuela's shrinking assets. Any future government will face the monumental task of restructuring this debt to rebuild the nation. Citgo, the U.S.-based refining arm of Venezuela's state oil company PDVSA, stands as the country's most valuable foreign asset. For years, Citgo has been a crucial link between Venezuela and the global energy market, providing a steady stream of revenue and a foothold in the American oil industry. Now, it has become the main target for creditors seeking repayment for Venezuela's mounting debts. When PDVSA defaulted on bonds that were backed by Citgo, a wave of bondholders and companies like ConocoPhillips rushed to claim the company as compensation. These creditors, some of whom have waited years for payment, see Citgo as their best chance to recover billions of dollars lost to Venezuela's economic crisis. In a dramatic turn, a U.S. court authorized the auction of shares in Citgo's parent company. This decision set off a frantic legal scramble, with dozens of claimants vying for a piece of the prized asset. The courtroom battles have drawn in lawyers, financial experts, and government officials from around the world. Losing Citgo would be a devastating blow for Venezuela. It would strip the country of a critical source of hard currency, further weakening its already battered economy and undermining any hope for future recovery. For many Venezuelans, Citgo represents not just an oil company, but a lifeline to stability. The Venezuelan opposition, with strong backing from the U.S. government, is fighting desperately to halt the sale. They argue that losing Citgo would make rebuilding the nation even harder. But despite their efforts, the legal battle rages on, with no clear end in sight. For U.S. energy firms and international investors, Citgo is the best hope of recovering billions in unpaid awards and settlements. The stakes are enormous, and the outcome could reshape the global oil market. The fate of Citgo encapsulates the entire conflict. A prized asset, pledged in desperation, now at the center of a high-stakes legal drama that has captured the world's attention. Its loss would symbolize the ultimate price of Venezuela's economic collapse, marking a turning point in the nation's long struggle with debt and decline. The outcome of this battle will shape Venezuela's future for generations, determining whether hope or hardship lies ahead for its people. While most U.S. oil giants left, Chevron stayed, navigating sanctions and political turmoil by accepting minority stakes and strict compliance. Chevron's patience has kept its foothold in Venezuela's vast oil fields, even as others fled. The company has maintained operations by following U.S. laws and securing special licenses, avoiding direct conflict with the Maduro regime. Chevron's strategy is long-term: stay through the crisis, preserve its assets, and be ready to ramp up if conditions improve. Leaving would mean losing decades of investment and ceding ground to rivals from Russia and China. Chevron's continued presence makes it a key player in any future recovery of Venezuela's oil industry. Its expertise and infrastructure could help rebuild production, if the political and economic climate stabilizes. Chevron's quiet endurance is a testament to the enduring allure of Venezuela's oil wealth. With Nicolas Maduro ousted from power, a new chapter in Venezuela's tumultuous history seems to be unfolding. Former President Trump has called for U.S. energy companies to return to Venezuela and revive its shattered oil industry. He believes that American expertise and investment can breathe new life into the country's vast oil reserves. Trump envisions American investment rebuilding oil fields and restoring prosperity, but only if political stability and contract protections are guaranteed. This vision, however, is fraught with challenges. The unresolved issue is that Venezuela still owes billions to U.S. firms from past expropriations. These debts have created a significant barrier to new investments. No company will invest without ironclad assurances that their investments will be protected. The memories of past losses are still fresh in the minds of many executives. The legal battles over Citgo and unpaid debts remain major obstacles to any new partnership. These legal entanglements must be resolved for progress to be made. For a true reset, Venezuela must resolve old claims, guarantee new contracts, and ensure that the rule of law is upheld. Creating a stable environment for foreign capital is crucial. Investors need to feel confident that their investments will be safe and profitable. The prospect of revitalizing Venezuela's oil sector is tantalizing. The country has the potential to become a major player in the global oil market once again, but the ghosts of the past loom large. The memories of previous mismanagement and corruption are hard to forget. The future depends on whether both sides can learn from decades of conflict and mistrust. Building a new relationship will require patience, transparency, and mutual respect. Only then can Venezuela's oil wealth become a true engine of recovery, driving economic growth and improving the lives of its citizens. Otherwise, it risks remaining a source of endless strife and missed opportunities.